I have a target on my gold of 3,000. I'm likely to raise that by several $100s. I think it's conservative at this point, given that gold's at 2,500. My silver call is $75. It had been 60, and I raised that in my last letter. So I think silver can go to 75, let's say between now and the end of the first quarter. And gold to 3,000. I wouldn't be surprised if it's several $100s higher than that.
Chief Macro Strategist at Contrarian Macro Advisors, David Hunter. Welcome back to the channel.
Hi, Dave. Great to see you.
Great to see you as well. I always really enjoy our conversations, and the last one was about 8 months ago. The Dow was sitting at about 37,500. And you were telling everybody that we were going to see a crack up boom and that 45,000 could be on the table for the Dow. We're currently sitting not too far away from 41,000. And we, close to all-time highs on the Dow, just one of the indexes. We're also looking down the barrel of a number of rate cuts, which is fairly unusual when you have stock markets at all-time highs. Is this the start of your crack up boom?
Yeah, I think we're in it. I must talk to you just before my January letter went out, and
that's right. Yeah.
In my January letter, I raised my Dow forecast to 55,000. So 45,000 was already considered crazy by most people, and I still saw potential for even more than that. So my S&P was raised to 7,000, and my NASDAQ number is now 24,000. I raise that later on, but
we're looking at 55,000 now on the Dow, 7,000 S&P, and 24,000 on the NASDAQ. That's what you're calling for now.
And my Russell 2000 number is 3,300. I had a 3,000 target on that and raised it to 3,300 back then. So it's crazy. I mean, from here to 3,300 on the Russell is probably 55%, just below 60%. And I think we can get there this year. So some crazy numbers.
This year.
Yeah, and that's what I mean by melt up. Yeah.
Because we're just the end of August now, so that gives us 4 months into the end of the year.
Yeah, it's going to be steep. I mean, I won't be, it won't be totally out of the question that it extends. My forecasts tend to extend, but I think there's a real possibility, if not likelihood, that we see it this year.
You get a lot of flack for your calls on these things. Let's break it down. What's going to drive the markets to the levels that you're talking about?
Yeah, so if you go back to October 2022, when the market bottomed out, the S&P dropped down to about 3,500, just below 3,500, and turned. And I was bullish and said this looks like the bottom of the bear market we had in 2022. And I was talking melt up way back then. People thought I was nuts because I had that 45,000 number on the Dow and 6,000 for the S&P, and most people didn't think we were going to get anywhere near the old high of 4,800 back then. So the street, institutional investors as well as retail, fought this market all the way back to the old high. So 4,800. I got up to 4,600, pulled back to 4,100. I pretty much saw that coming and talked about it and called it. And then at 4,100, people were looking down again, and it turned and ran to new highs. It's been my point of going through all that is it's been a wall of worry all the way through this run. I mean, unusual to have that big a run and not have people getting bullish. But basically, until we got to new highs, everybody was selling this market, or at least saying there's, this thing's running out of gas. It can't go any further. And they said that all the way up. Then we got to new highs, probably took them to get up over 5,000. And they started becoming somewhat believers, or at least what they became was, I've missed so much. I can't stay bearish. I got to get on board. So they started kind of couching their views and saying, yeah, maybe we can get up to the mid 5,000s. I think year-end targets for most of the street were somewhere between 5,200 and 5,600. And we got there. We got to 5,600, 5,760, I think, somewhere in there, 5,680, I can't remember, but got up there. And we've obviously had this sell-off where, people said, okay, we had the, August 5th sell-off where, we had the yen carry trade reversal and unwind, and we got a bad jobs number that Friday and the Friday before that, and everybody ran with that and said, "Oh my God, the Fed didn't cut rates 2 days ago. They missed it. We're now in recession and we're heading for a bust. We're heading a disaster." And so, in about 3 or 4 days, you had the market, give back a good chunk of money. I mean, the Dow was down 8.5% from its high, Nasdaq double digits. The semis, which had kind of led the market, got hit hard. Down maybe, I can't remember what it was, high teens or 20%, but pretty hard. So it looked like, okay, to those people who were skeptical all the way up, it looked like, okay, we've seen our top, and now we're going lower. And so you heard a lot of calls over the last couple of weeks of, yeah, we can get a relief rally, but we're going lower. And some people going a lot lower, and others, we're going back to 4,800 to retest or what have you. So my point is, what you've had, in spite of this huge move from 3,500 to 5,600 plus, is you've had a surprisingly skeptical investor. And so it doesn't take much. It only took that 8.5% pullback in the S&P to rebuild the wall of worry. And that's what we've seen all the way up, is that what I say is those that got on board and became more bullish were there without conviction. They were only there because the tape was going up and they couldn't afford to be bearish. So as soon as they get the reason to get bearish again, they jump right back on that bandwagon and say, oh, we're going down. That's healthy. I mean, what we have here is a lot of fear in the market. They're caught in the middle because they, every time it starts going up, they want to sell, but they go, I've got burned, I got to stay on board. But there's a lot of money on the sideline. There's a lot of defensiveness in institutional portfolios. And I think that's the fuel that's going to allow this thing to go higher. What it needed was the Fed, and then the Fed's dragged its feet, doesn't want to cut, but it's pretty much now pretty obvious the Fed's going to cut at their September meeting. The only question is, are they going to cut a quarter or a half? I think that's what we're waiting for here. What you're seeing in the economy is signs that the economy is slowing, no question about it. The consumer is starting to run out of gas, no question. He's still spending, but he's having to take more out of savings, and his savings is being depleted. They're spending, you look at the monthly numbers, and they're spending more than the income coming in. So credit debt is going up. You're seeing delinquencies go up. So a lot of signs that we're getting to the end of this cycle. But then we get news after they got all worried about recessions here, and we got a surprisingly good consumer number, consumer spending number. We've had good inflation numbers. The service sector today's service sector ISM was 55, so that looks like it's still fine. Manufacturing's below 50, so that manufacturing is in recession probably, or at least slowing. But the point is, I think we have enough information out there to say we're in a soft landing. It's going to be a narrative, I think, from here into the election, where it's going to be soft landing, Fed's on board, easing, and inflation's falling, or inflation's continuing to slow. And I think that's the narrative that drives us. The reason I went through all that about the skepticism is that there's plenty of pent-up demand. And I think you're going to see finally, as this thing comes out of this pullback and goes to new highs, you're going to have people finally getting on board, because with the Fed easing, I think what you're going to get from the institutions is a view that we now can look out to 25 and 26 and say the economy is going to pick up speed. Inflation is still going to be under control, and that's very bullish. So it's kind of a Goldilocks scenario that I think you get. It won't last long. That's what they believe. They can start building in higher earnings for 25, which is what now is going to drive the market. It's not this year's earnings anymore. It's next year they're looking at. I think you're going to have growing earnings, lower interest rates, and lower inflation. And I think because so many people are in the same boat, skeptical, you're going to have short covering, you're going to have people having to get on board, people moving from defensive to more aggressive, and the momentum of the market's going to ultimately lead to FOMO.
So we're talking about a roughly 35 to 40% rally from here. So you're saying that a lot of the motivation on this is we're looking forward. We're saying things are getting slightly better. Economy is looking slightly better. Future earnings are going to look slightly better. We've got institutional money moving in. And then we'll see, is it institutional or is it more retail money that's moving in from a FOMO point of view and just riding this higher?
Yeah, probably both. And I'd probably say that the narrative is not going to be slightly better. I think you're going to see somewhat, a ramping up of earnings, a ramping up of expectations for 25. And again, that's not my view. My forecast for 25 is quite dire. But I think for a period of time between now and the election, I think the narrative is going to be better earnings, maybe even significantly better earnings, and inflation under control, significantly lower interest rates. I think the 10-year can get down to 2.5% this year.
Wow.
So if you get a 2.5% 10-year and the Fed cutting rates, so short rates coming down, all of a sudden you've got wind at your back.
You got a lot of money chasing the stock market.
Yep.
You talked to us before when back in January, you were saying the long term, you're looking at inflation significantly higher, though. You're talking about 25% inflation was what you were mentioning last time. Is that still where your head is at?
Yeah, that's absolutely where I'm at. My forecast hasn't changed at all in terms of my long-term forecast. You've got to get through.
And when you say long term there, give us a time frame on that, just so that we can manage expectations.
The 25% inflation's, late this decade, early next. So it's 2029 or 30, probably, maybe 31, but somewhere in there. And it comes as a result of next year's bust. I'm calling for a global bust next year. And I described that as something worse than 2008-9, a financial crisis that exceeds 2008-9, an economy where you could see almost maybe even double-digit unemployment in this country, but certainly high single, if not double. And like I said, a financial crisis where you have bank failures, probably more over in Europe than here, but because we had, we got hit so hard in 2008-9, our banks are in better shape than yours. Canada looks like we did in 2008-9. Their banks, were in good shape then. They're not so good now. Australia obviously has real estate up in the stratosphere, so I think their banks are vulnerable. Asia, Asian banks are vulnerable. China and Japan both. So you've got, I think the potential for something we haven't seen in the post-World War II era in terms of a very bad economy, very bad financial system, crack up next year. The response to that, and Powell it's not on his radar right now. He has no idea we're going to see this. He's worried about a recession, but not what I'm describing. They can sit and talk all day long about we're not going back to QE again. He's made that statement many times that, we learned our lesson. We're not going to do what we did, in the last decade. We're not going to just print money ad infinitum and, blow up the stock market and blow up the economy, meaning like blowing up a balloon. So That's his belief, is that they're going to stay disciplined and not pump up everything, pump up the balance sheet. But when you're faced with a free falling financial system, which is what I'm describing, is why I say it's going to be even worse than 2008-9. You're going to have bank failures dominoing across the world. You're going to have all kinds of corporate issues, real estate issues, etc. And again, it's global. Every central bank in the world is going to be deer in the headlights saying, what do? We got to print money. We got to pump this thing up again. And they're going to start trying to be disciplined. We're not going to put 5 trillion in. We're going to only do a couple trillion. And they're going to find that didn't stop anything. So then they do another 3 or 4 trillion. That didn't stop anything. Ultimately, I think what it will take to bottom this thing out and turn it up will be perhaps $20 trillion coming out of the Fed. So, our balance sheet got up to 9 trillion. We blew it up by 5 trillion back in the pandemic, back in 2020, 21. We're going to see 4 times that, in my opinion, and proportionally around the world, all the central banks will be doing similar, not the same numbers, but proportionally. And so you will have money coming out of everywhere and being matched by fiscal. We'll be issuing new treasury debt like crazy to match that, and they'll monetize it with a lag initially. And the reason they'll be doing that is to try to, stop a free falling system. The lag to when that turns into inflation is probably 18 months or more. So into any kind of serious inflation, because we'll be in deflation next year, I think.
Mm-hmm.
Next year is going to be, once you hit this bust, it's going to take us into deflation. So they'll have the infinite ability to print money, because the lag to when that shows up as inflation is a couple of years out. So they're going to be faced with, they're not going to be worrying about inflation. They're going to be worrying about saving the system. Once they print that kind of money, with that lag by let's say the second half of 26 or 27, inflation's back up into, higher single digits. I don't know whether that's 6 or 7%, let's say, moving towards double digit. By the time you get to 28, I think you're well into double digits. By the time you get to 2030, in this country, it'll be, I think, well over 20%. Mm-hmm. So, again, it's because of those leads and lags, and we're at the end of what I call, 80, 90 year super cycle. And I define a super cycle as that big cycle between 2 depressions. Mm-hmm. A depression in the 1930s and a depression in the 2030s. Next year is not a depression. Next year's, it's going to be straight down and straight back up. It's going to be a V, but it's going to be, while you're in it, it's going to feel like a depression. And I think you can have an 80% decline in the stock market, an 80% bear market from the peak. So if we get 7,000 on the S&P, it can fall to 1,400. And again, I'm not going to be precise, but I mean, that's just to give you an idea of what I'm talking. And then from there, that money that will be printed will, they'll be coming up with every program they can, just like they did in 2020, to help the consumer, to bail out pension funds, to keep the money markets, buck, et cetera. And that money will find its way into assets. We will see a commodity cycle following the bust. So beginning in 26, probably later 26, and all the way through the balance of the decade, you could take oil to $500. I think oil next year can get to $30, but by the end of the decade could be at 500. Copper could get down. I'm calling for copper this year at 6. Could get down to $1 and somewhere near $1 in the bust, and then by the end of the decade could be 20 or 30. So and the problem is, what you're going to do is you're going to, with that, and I say 20 trillion, it's just a seat of the pants guess, but with that 20 trillion, it's gonna goose demand. You're gonna get this huge demand in a couple of years out, and we're going to be reindustrializing. We're reshoring, we're bringing the industry back from China, et cetera. So the consumer is going to be digging out from an 80% bear market and double-digit unemployment. They're not going to be in any big hurry to spend, or they're not going to have the wherewithal to spend. So it's not going to be a consumer-driven economy like we've seen for the last 30 or 40 years. It's going to be back to the 70s and early 80s where it's industrial, big capacity buildup. Semiconductors, we're already seeing it. Obviously, we're seeing it in steel. We'll bring steel back here, et cetera. And I think the world's going to be resourcing things, reindustrializing. And what we've done is over the last, let's say the last 30 years or more, we've rationalized down our infrastructure. So, our capacity for producing commodities. So if you goose demand and it comes back quickly because of all that money, it takes a good 7-8 years to build demand to match that, right? So you're going to have demand through the roof for commodities
and limited supply,
limited supply. And so the only thing it can give is price. So for a period of 2 or 3 or 4 years, you're going to have prices going straight up. I think I gave you a number on oil. Natural gas will go through the roof. I think all base metals will go through the roof. And gold, I think, can get to 20,000. Silver can get to 500. It'll be it won't be there long. It might last a few years, but it'll create a problem because not only do we have 320 trillion in debt now, we are probably going to go to 500 trillion in the bust or soon after the bust. So we'll have 500 trillion in global debt, and interest rates will match and will be following inflation up. So in this country, we'll be looking at 15 to 20% interest rates or higher with debt that we can't service now at 5%. It leads to something very dire, a depression, far beyond what we saw in the 1930s, out, let's say, in 2033, 4, 5, somewhere out there.
What happens between now and 2025 to precious metals?
Okay, I think this year, and it can spill into the first part of next year, I have a target on my gold of 3,000. I'm likely to raise that by several $100. I think it's conservative at this point, given that gold's at 2,500. My silver call is $75. It had been 60, and I raised that in my last letter. So I think silver can go to 75. Let's say between now and the end of the first quarter, and gold to 3,000. I wouldn't be surprised if it's several $100 higher than that. In the bust, almost all assets will go down except maybe U.S. Treasuries and cash. But in the bust, I think gold can probably, if it goes, let's say it goes to 33, 3,400, it might come all the way back here, back to where it broke out, 2,100, 2,200, somewhere in there. Silver at 75, it could easily come back 50%, maybe 75% from there, because it's a much more industrialized, demand-driven commodity. So I think they'll get hit hard if the stock market's hit 80% and silver drops 70%. You've outperformed, but it's a big hit, right? Yeah. So, and I don't know that it'll come that far. It might only go 50, but it's not something that you can just buy and hold and say, I'm not worried about the bust. I think you're going to be very upset if you just kind of sit there. And as I say,
it's by volatility.
It's kind of like standing on the south rim of the Grand Canyon and looking across to the north rim and thinking you can walk straight across, and there's this canyon in between that you don't want to ignore.
Now, long term, you're not painting a very rosy picture. What can be done to avert what you're talking about? or can anything be done by governments or
Yeah,
central banks?
where I could be wrong is that it obviously won't be as extreme as this. If we don't have the extreme bust, we're not going to have the extreme response. I view it as pretty baked in the cake, given what we've done is we've ramped up it cycle to cycle. So that's why you have a super cycle, is because you start coming out of the Great Depression, and in the first couple of cycles you have plenty of capacity, and the ramping up doesn't cause any big problem. So we got through the 50s without a lot of inflation. You get into the 60s, inflation comes, but then you have to tighten up and you bring it down. Well, what we've had is really starting in the 60s and 70s, each successive cycle has taken more medicine to pull us out, taken more to crank it down because inflation got higher. And then you overstayed your tightening and you created the opposite. And then it took more to get you out of that. So each successive cycle for the last several, we've gone to more extremes on the downside and the upside. And so you had 74 was an awful economy. And then you had the huge inflation in the early 80s. You went through a long period of disinflation. And now we're into cycles where 2007-8 was awful. It was the worst we've had in the post-World War II era. Took an awful lot of medicine to get us out of that, and a long period of medicine to keep it going. And that created the opposite excess. We saw it in 2022 with inflation. They cranked it down, but they're still trying to get it down. And I think the Fed's overstaying. The Fed and central banks are overcompensating, over tightening, because of leads and lags that are fairly lengthy and uncertain. The central banks always go too far in each direction. But what we're doing now is kind of like that, sine wave. It just gets more extreme in each direction, and until it finally just blows off, and then you're really out of options. And the reason you can have a collapse in the 2030s is because far before that, sometimes say 2028, the printing press is totally out of the picture. They'll try modern monetary theory of printing more money to pay for your servicing, but what that's like. It's like having a hose with gasoline coming out of it trying to solve a forest fire. It's you're gonna get to the Weimar Republic, and that won't be that bad, but type of a problem where the minute you print money, it goes to even higher inflation and higher interest rates. So you're not getting ahead, you're getting behind. So then the printing press is gone, and that's the only thing that's really sustained us for the last several cycles. Is they just keep blowing it up higher, and we've reached the end of the Ponzi scheme. Is basically what we're coming to.
What we're going to get to a point where everything effectively collapses, cannot be reinflated by the modern monetary theory. What are we left with then?
That is the hardest question, and I can't answer it. And my fear is, because this is global. I mean, we'll see, the global collapse, sovereign debt is going to prove itself to be not safe. You're going to have bankrupt governments. As I say, and again, this is totally just trying to paint a picture from the seat of the pants, but we could possibly see in this country 50% plus unemployment with a bankrupt government. That means no welfare system, no unemployment compensation, very limited, if any, Social Security or Medicare. Basically everybody fending for themselves, trying to survive. And again, it will be something similar around the world, I think. And so what comes out of that? I fear totalitarianism, but who knows? I mean, maybe we do somewhere along the line come out of the ashes and start the whole game over with a gold-based system, and learn our lesson and don't do it. But to get from here to there is going to be extreme pain, in my opinion. So, but I hope that's the option, because if it's totalitarianism, it's I don't want to contemplate what that is for our kids and grandkids.
Indeed. One of the things that I admire about you, David, is you get an awful lot of flack online for your calls and your way of thinking, but you stay stalwart and rigid in them. What is it, or how is it that you look at the markets? What is it that other people are missing that you see, or that allows you to see this path forward for markets and this crack up boom? Because, you know, again, we were sitting back here at the beginning of the year and the market looked like it was going lower, and it was 37,000. And you're saying we're moving to 45 as it was then. You're calling it higher now, but we're more than halfway there at this stage. So you've been proved right in a lot of your calls. What lens are you looking through that others aren't?
Yeah, it's a couple things. One, keep in mind, I've been a contrarian basically I came into the business in '73 as in the investment business on the buy side, and I became a contrarian pretty quickly, and I think I probably am a natural contrarian in terms of my personality. It just doesn't bother me to be outside the crowd.
Mm-hmm.
And I've observed through all my jobs on the buy side, I always observed, and I'd always found people in my own firms as well as people on the street. I'd call them my contrarian indicator because people just didn't want to be outside the crowd. They would just go, and once you got, you had everybody parroting the same thing, and they were comfortable doing that. I said, "Don't you see? It's discounted." So part of it is just a lifelong or career-long 50 years of being contrarian. So it doesn't bother me that I'm saying things that nobody thinks is possible, or that people think I'm crazy to say. It doesn't cause me to say, well, maybe I got to lighten up on my call. So I'm able to be pretty straightforward. I could be wrong, but I'm able to be pretty straightforward with my views without my psychology getting in the way and saying, no, you can't say that because you're going to get ridiculed. So that's a big part of it. And then I have spent 50 years with a macro training. Really, I was a top-down money manager when I was running pension money, more than bottom up. So macro's always been a big part of me, and I naturally kind of gravitated to being a macro strategist from that. I think I do macro better than most. And again, I have the ability to kind of to look out beyond for whatever reason and look from cycle to cycle and not say, well, I think most people think the closer you are to your call, closer to the time frame of your call, the more accurate you're going to be. I actually am generally the opposite. I feel if I broaden out my perspective, I can see the picture even better. If I'm trying to call the next month, I'm going to get it wrong lots of times, or call the next 3 months, you can get it wrong. You put it out, 5 years, and I feel very comfortable seeing things. Now I'm not worried about whether I have the time right. I might be wrong. I might be off in terms of, when I throw out 29 or 30, 2030, these things have a way of kind of taking longer and stretching out. But that framework I'm very comfortable with. And again, it's degrees. I'm not saying I know it's going to be to the degree I'm talking, but I think I've got the cycles pretty much. I understand the cause and effect of where we're going.
You've grown a thick skin over the years as well.
Yeah. I mean, I have people call me, stupid and dopey and crazy, and I people will say, "Why don't you just block that person?" And I'll go, they have a point. I understand why they think it's crazy. I said, these are extreme forecasts, but they're extreme because of where we are in the super cycle, not because of me. I'm not just trying to get attention.
Yeah. Well, what we do is we're going to have you back on again in a little while, and you can either say "I told you so" or give us your thoughts as to what happens next. But for now, David Hunter, thanks for joining us on the channel.
Thanks, Dave.